If we're bearish, would we want to see this entire range completely repriced too on the upside of it? In other words, overlapped with movement up? No, we don't want to see that. Why? Because if it starts keeping these things open, remember I was teaching you about the 5-minute fair value gap here where it was left open. I would want to see that stay open on above this high here, not completely overlap that candle. The same idea there is what we would expect here. We want to see the upper portion of an inefficiency stay open. So every single time an inefficiency manifests itself in price, if I'm bearish, I am actively interested in seeing if it stays open. The upper half of it needs to stay open. As long as it's doing that, that gives it lots of room to keep going down. Why? Because it becomes a measuring gap. Breakaway gaps, measuring gaps, and then you can have exhaustion gaps. So this inefficiency, we would want to see the upper half of that stay open. Why? Well, several factors. Number one, it would invite the likelihood of continuation going lower, which we haven't even traded to the sell side here, which is that red level. So the stops or sell stops below that red level haven't even been engaged yet when this was formed there. We have an old low here. So the likelihood of it going up and completely overlapping this one down closed candle and still going lower, I don't like that. So if I was in a trade and I saw this going up to that point there, it would be extremely critical for it to immediately and aggressively reject that and go a lot harder lower. If it was meandering around and not willing to go aggressively lower after going into the high end of this level here, then I would kill the trade. I would collapse it and just be done, because to hold on to a trade like that in an area where I know the likelihood or probabilities would be shifted against me, then I'm going to start spending mental capital. Even if I have open profits in the trade that have not been realized yet, haven't closed the trade, I'm going to start spending mental capital, meaning I'm going to be worrying and stressing about something that I don't ultimately have any control over. And then I'll start wrestling with the idea, if I get out, it might move in my favor and I'll regret that. If I stay in, it's going to eat up more of my profits. So as soon as you start getting to that point in your trade, are you in control of your trade anymore? No. So you just abandon it, abort it, take your profit, whatever it is, and move to the next opportunity. If it goes against you and would have stopped you out, wonderful, you did the right thing. If it moves in your favor and goes to your target, wonderful. That means your model was correct and you managed yourself correctly. You have to manage you. So if it's not going to go in the upper portion of this gap and trade higher and close it in or reprice to it, we want to see the halfway point or less be sensitive. And here's 25% of this SIBI. I'll show you what that means. From this candle's low to this candle's high, you can see it here. 0.25 is the measurement from this candle's low to that candle's high. So if I'm bearish, I want to see the market respond aggressively and sell off at either the quarter or the halfway point and not trade up into here. Because the algorithm, if it does these things like that, that's like a warning sign for smart money to just be careful, don't add new positions. What's the high of that candle right there? 15,652.75. What's the quarter level? 15,652.75. So the market goes up into that range. We want to see it stay open. If it closes, then you have to deal with it differently. But every inefficiency, I'm trying to anticipate them staying open. If I'm bearish, I want to see the upper half stay open. If I'm bullish, I want to see the lower half stay open. They may come back down and reprice. If it comes down and reprices, and it hasn't, like for instance, if this would have repriced to the upper end of that candle's low, if it would have done that, and it did not go below this red level, which is the sell side liquidity pool on the 5-minute chart, that means that I would still be willing to hold the trade, but it needs to start dropping aggressively once it gets there. It cannot wait around and spend time like it was doing here, consolidating, and then goes to the lower quadrant of that sell side and balance buy side efficiency, then dropping. I don't want to see that once it does this, goes back up again. If it would have done that, I would have held the trade, if it would have done that, but it would have been a time stop added to it. That means as soon as it touched this candle's low, it's got 2 fucking minutes to get in my favor and outside of that range here. If it doesn't do it, I'm taking half the trade off or all of it, because the likelihood is they may not come back down here to take that sell side until New York. Big paradigm shift what I just gave you there.